A 50-year agreement shattered overnight. When the petrodollar dies, every price you pay changes. What does this mean for gas stations, grocery bills, and your savings? Today, we uncover one of the most explosive financial earthquakes in modern history. You will learn why the foundation of dollar dominance just cracked wide open. What is really happening behind closed doors in Riyadh? How this seismic shift could demolish currency stability and reshape power across continents. You will discover the hidden timeline, how Saudi Arabia quietly prepared for this moment throughout 2024 and early 2025. How the world's most crucial oil exporter just walked away from the deal that made America's currency king, and what that decision reveals about trust, allegiances, and the desperate scramble for the next global reserve currency. We will also break down what forces geopolitical, economic, and strategic are driving this collapse, and why nations from Beijing to Moscow are celebrating while Washington panics. Spoiler, it is not just about oil. It is about who controls the future of money itself. Stay with me to the end, because by the final minute, you will grasp why this is more than a policy shift. It is a revolution, a reckoning, and possibly the beginning of a post-dollar world. Welcome to our channel. If you want more explosive analysis like this, hit subscribe and smash that bell. The petrodollar system explained. The petrodollar system began in 1974 when the United States struck a landmark deal with Saudi Arabia. The agreement was simple but world-changing. Saudi Arabia would sell its oil exclusively in US dollars. In exchange, America would provide military protection, weapons, and security guarantees to the Saudi kingdom. This arrangement was then extended across OPEC, creating a global standard. Oil, the lifeblood of the modern economy, could only be purchased in dollars. If Japan wanted Saudi oil, it needed dollars. If Germany wanted oil, it needed dollars. If China wanted to fuel its factories, it needed dollars first. This created automatic, relentless demand for the US currency worldwide. The benefits for America were staggering. The petrodollar system meant that every nation on earth needed to hold large reserves of US dollars just to keep their economies running. This demand allowed the United States to print money with less fear of inflation, because dollars were constantly being absorbed by global trade. It gave America enormous leverage in international relations. Countries that wanted oil had to play by dollar rules. It enabled the US to run massive trade deficits without immediate consequences, because the world kept recycling dollars back into US Treasury bonds. And it cemented the dollar as the undisputed global reserve currency, making America the financial center of the planet. For 50 years, this system held. Through wars, recessions, political upheavals, and financial crises, the petrodollar remained the invisible architecture holding up American economic power. But systems built on agreements can collapse when those agreements end. And in 2025, that is exactly what happened. The break. Saudi Arabia walks away. In June 2025, Saudi Arabia made an announcement that sent shockwaves through every financial capital on earth. The kingdom declared it would no longer sell oil exclusively in US dollars. Instead, Saudi Arabia would accept payment in multiple currencies, including the Chinese yuan, the euro, and even digital currencies backed by commodities. The 50-year petrodollar agreement was over. No extension, no renegotiation, just a clean break. The numbers behind this decision reveal the scale of the shift. Saudi Arabia is the world's largest oil exporter, shipping roughly 7 million barrels per day to customers worldwide. When priced in dollars at around $80 to $90 per barrel, that represents over $500 million in daily transactions, all of which previously required US currency. Now, that demand vanishes. Countries buying Saudi oil can pay in yuan, euros, or other agreed currencies. The automatic global need for dollars just took a massive hit. The implications are immediate and severe. First, demand for the US dollar drops sharply. When fewer buyers need dollars to purchase oil, the currency weakens. A weaker dollar means higher import costs for American consumers. Everything from electronics to clothing to food that comes from abroad gets more expensive. Second, inflation pressures build. As the dollar loses value, the cost of goods rises. Americans could see prices climb at gas pumps, grocery stores, and across the economy. Third, U.S. Treasury bonds become less attractive. Foreign governments that once bought treasuries to park their dollar reserves may now shift to other assets, raising U.S. borrowing costs. And fourth, America's geopolitical leverage shrinks. Without the automatic need for dollars in oil markets, the U.S. loses a powerful tool for enforcing sanctions, shaping trade policy, and projecting economic influence. The Saudi decision was not made in isolation. It reflects years of shifting alliances, growing frustration with U.S. foreign policy, and calculated positioning for a multipolar world. The kingdom watched as China became its largest oil customer. It observed the rise of alternative payment systems and the growing desire among emerging economies to escape dollar dominance, and it chose to act. The break was clean, deliberate, and devastating. Why Saudi Arabia made this move? Several powerful forces converged to push Saudi Arabia toward this historic decision. The first and most obvious factor is China. Over the past decade, China has become the largest buyer of Saudi oil, importing millions of barrels daily to fuel its massive industrial economy. China has also invested billions in Saudi infrastructure, technology projects, and joint ventures. This deepening relationship created both economic dependence and strategic alignment. China has been pushing for years to settle oil trades in yuan rather than dollars. The Shanghai Petroleum and Natural Gas Exchange launched yuan-denominated oil futures in 2018, laying the groundwork for this shift. Saudi Arabia's move is the culmination of that effort, a decisive step toward a yuan-backed oil market. Geopolitical tensions with the United States also played a major role. Saudi Arabia has grown increasingly frustrated with American foreign policy in the Middle East. Disagreements over Iran, shifting U.S. energy independence due to domestic shale production, and perceived unreliability in security commitments have strained the relationship. The Saudis no longer see the U.S. as the indispensable partner it once was. Meanwhile, rising powers like China and Russia offer alternative partnerships without the political conditions and criticisms that often accompany U.S. relations. Economic diversification is another key driver. Saudi Arabia has been working for years to reduce its dependence on oil revenue through its Vision 2030 initiative. Part of that effort involves building stronger trade and investment ties with multiple global powers, not just the West. Accepting multiple currencies for oil sales fits naturally into this strategy, allowing the kingdom to hedge its bets and avoid over-reliance on any single economy or currency. There is also a broader global movement toward de-dollarization. Countries including Russia, Iran, Brazil, and India have been exploring alternatives to the dollar in trade settlements. The BRICS nations, Brazil, Russia, India, China, and South Africa, have discussed creating their own currency or payment systems to bypass dollar dominance. Saudi Arabia's decision accelerates this trend, giving momentum to efforts aimed at building a multipolar financial system where the dollar is no longer the default. Finally, the rise of digital currencies and commodity-backed financial instruments has made it technically easier to move away from the dollar. Blockchain technology, central bank digital currencies, and agreements to settle trades in gold or other hard assets provide new tools for conducting international commerce without relying on the U.S. financial system. Saudi Arabia is positioning itself at the center of this transformation, leveraging its oil wealth to gain influence in the next generation of global finance. All these factors combine to create a perfect storm. The petrodollar system, once seen as permanent, suddenly looked outdated and vulnerable. And Saudi Arabia, reading the shifting tides, chose to act decisively. Immediate consequences for the dollar in global markets. The moment Saudi Arabia announced its decision, financial markets reacted with alarm. The US dollar index, which measures the dollar's strength against a basket of major currencies, dropped sharply. Within days, the dollar had fallen over 5%, erasing months of gains and signaling a loss of confidence among traders and investors. Currency analysts warned that this could be just the beginning. If other oil exporters follow Saudi Arabia's lead, the dollar could face a sustained long-term decline. Oil prices spiked immediately. Markets feared supply disruptions and uncertainty over payment mechanisms. Benchmark crude jumped past $95 per barrel as traders scrambled to understand the new landscape. Higher oil prices translate directly into higher costs for transportation, manufacturing, and energy, feeding inflation across the global economy. American consumers felt the pain almost instantly. Gas prices at the pump surged, with some regions seeing increases of 30 to 40 cents per gallon within a week. Heating oil, jet fuel, and diesel costs all climbed, squeezing household budgets and business margins. U.S. Treasury yields also moved sharply higher. As foreign demand for dollar assets weakened, investors demanded higher returns to hold U.S. government debt. The yield on the 10-year Treasury note jumped from around 4.2% to nearly 5% in a matter of days. Higher yields mean higher borrowing costs for the federal government, adding billions to the national debt burden. They also push up mortgage rates, car loan rates, and corporate borrowing costs, slowing economic activity and increasing the risk of recession. Stock markets tumbled as investors processed the implications. The S&P 500 fell over 8% in 2 weeks, wiping out trillions in market value. Technology stocks, financial companies, and energy firms all saw steep declines as uncertainty gripped Wall Street. Pension funds, retirement accounts, and investment portfolios took significant hits, affecting millions of Americans planning for their financial futures. Beyond the United States, global markets experienced severe volatility. European stocks dropped as the euro strengthened unexpectedly, hurting exporters. Asian markets swung wildly as traders tried to assess whether the yuan would become the new anchor currency for energy markets. Emerging economies faced capital flight as investors pulled money out of riskier assets and sought safety. The entire global financial system suddenly felt less stable, less predictable, and far more dangerous. Central banks around the world scrambled to respond. The Federal Reserve issued statements aimed at calming markets, but its options were limited. Raising interest rates to defend the dollar would risk pushing the U.S. economy into recession. Lowering rates to stimulate growth would further weaken the currency. The Fed found itself trapped between bad choices, unable to easily stabilize the situation. The message was unmistakable. The petrodollar's collapse was not a theoretical concern or a distant threat. It was happening in real time, and the consequences were already reshaping markets, economies, and financial stability worldwide. What comes next? 3 possible scenarios. The first scenario involves a rapid shift toward a multipolar currency system. In this outcome, the yuan, euro, and other currencies gain significant ground as alternatives to the dollar in international trade. Saudi Arabia's decision becomes a catalyst, encouraging other oil exporters, including the UAE, Kuwait, and even Iraq, to accept multiple currencies. China capitalizes on this moment, pushing the yuan as the preferred currency for energy and commodities. The Shanghai Exchange becomes a rival to traditional Western financial centers. Global trade fractures into regional currency blocks, with Asia increasingly transacting in yuan, Europe in euros, and the Americas still clinging to the weakening dollar, the United States loses its ability to unilaterally impose financial sanctions, as countries can simply bypass the dollar system. American economic influence declines sharply, and the cost of maintaining its massive national debt becomes unsustainable. Inflation spikes domestically as import costs soar. The standard of living for average Americans falls as purchasing power erodes. This scenario represents a managed decline, painful but not catastrophic, as the world adjusts to a new financial order. The second scenario is far more chaotic. In this outcome, the dollar collapses rapidly, triggering a global financial crisis. Panic selling of dollar assets spreads as investors flee to safety. U.S. Treasury bonds, once considered the safest investment on earth, are dumped in massive volumes. Interest rates skyrocket, making it nearly impossible for the government to finance its operations. Hyperinflation takes hold as the Federal Reserve is forced to print money to cover obligations. Grocery prices double or triple within months. Savings evaporate. Retirement funds become worthless. Social unrest grows as millions struggle to afford basic necessities. Internationally, the crisis spreads. Countries holding large dollar reserves suffer devastating losses. Banks and financial institutions fail. Trade grinds to a halt as payment systems break down. A deep, prolonged global recession follows, comparable to or worse than the Great Depression. Geopolitical instability rises as nations blame each other. Competition for resources intensifies, and conflicts erupt. This scenario represents the nightmare outcome, a total collapse of the existing financial order with catastrophic human and economic costs. The third scenario envisions a dramatic U.S. response aimed at salvaging dollar dominance. In this outcome, the United States acts aggressively to shore up confidence and demand for the dollar. The government negotiates emergency agreements with key allies and trading partners, offering incentives, security guarantees, or economic concessions to keep the dollar central in global trade. The Federal Reserve intervenes massively, using its balance sheet to stabilize currency and bond markets. Washington leverages its military and diplomatic power to pressure nations considering abandoning the dollar, potentially threatening sanctions or worse. The U.S. also accelerates development of a digital dollar, launching a central bank digital currency designed to compete with China's digital yuan and offer a modern, efficient payment system. Major corporations and financial institutions rally behind the dollar, coordinating campaigns to reassure markets. If successful, this aggressive strategy could slow the decline, buying time for the U.S. to adapt and maintain a significant, if reduced, role for the dollar in global finance. However, this scenario requires political will, international cooperation, and flawless execution, none of which are guaranteed. Each scenario carries profound implications, not just for governments and investors, but for ordinary people everywhere. The path forward will be determined by decisions made in Washington, Riyadh, Beijing, and financial capitals worldwide over the coming months. The stakes could not be higher. Recap and what this means for you. The petrodollar system, the 50-year foundation of American economic dominance, has been shattered. Saudi Arabia's decision to accept multiple currencies for oil sales represents a turning point in global finance. What seemed permanent and unshakable has proven fragile when geopolitical alliances shift and economic interests diverge. This event demonstrates that even the most powerful systems can crumble when trust erodes and alternatives emerge. The broader lesson is unmistakable. Global economic power is not static. It shifts based on trade, relationships, currency confidence, technological innovation, and strategic decisions by major players. The dollar's dominance was built on agreements, infrastructure, and perceived stability. When those factors change, the currency's role changes too. And when the world's reserve currency weakens, the effects ripple everywhere. For ordinary people, these shifts are not abstract or distant. They hit wallets directly. Gas prices rise, grocery bills climb, mortgage rates increase, savings lose value. Jobs become less secure as businesses face higher costs and economic uncertainty. Retirement plans take hits as markets tumble. The cost of living goes up while wages struggle to keep pace. These are real, immediate consequences that affect families, communities, and futures. Beyond personal finances, the geopolitical landscape transforms. A weaker dollar means reduced American influence globally. Alliances shift. New power centers emerge. Conflicts over resources and currency dominance intensify. The world becomes more fragmented, more competitive, and potentially more dangerous. The rules that governed international relations for decades are being rewritten in real time. We want to hear from you. Do you think the United States can recover and defend the dollar's dominance, or is this the beginning of a post-dollar world? Will the transition be managed and gradual, or are we heading toward financial chaos? Your perspective matters because these events will shape the world you live in, the economy you navigate, and the future your children inherit. That brings us to the end of today's breakdown. The petrodollar is dead. The question now is what comes next. Share your thoughts in the comments below. Do you think this is a managed transition or the start of a currency crisis? If you want more fearless, in-depth analysis of the financial earthquakes reshaping our world, make sure to like this video, subscribe to our channel, and hit the bell so you never miss an update. Your support helps us keep uncovering the truth behind the headlines. Thanks for watching, and we will see you in the next one.